All right. Steve Peterson here, President, California Association of Real Estate Brokers. Getting ready to get started with the Understanding Group Investing webinar. Looking forward to connecting with everybody out there. Uh, this is a very important topic, understanding group investing. Very investing right now in 2018, especially in places like the Bay Area, where property prices are very expensive. Uh, Behooves us to start understanding how to invest in a group. And if you don't have a lot of capital to invest, uh, investing in a group is a great way to accomplish more than you can by yourself. This is critical. So we're gonna let a few more people chime in here. Then we'll get into the presentation. Also, if you're a member of the Oakland Investment Real Estate Meetup, this is our monthly meetup. This is the first webinar that we're doing. I think we're going to mix it up between webinars and physical meetings going forward. So this is a combination of the Oakland Investment Real Estate Meetup and the California Association of Real Estate Brokers webinar series. So we're talking about understanding group investing. Looking forward to your comments. And the format's going to go like this. We're going to go about 35 to 40 minutes within the presentation. Then I'm going to leave about 10 minutes or so, 15 minutes for some questions and answers if y'all have some, and then we'll wrap it up for there. Also, the webinar will be emailed out to all the attendees, and we're going to post the webinar on the California Association of Real Estate Brokers YouTube station. So if you missed this, or if you want to share it with somebody, you certainly will have that opportunity. A couple more minutes and then we'll hop right into it. Hope everybody's having a great day, a great Wednesday here in the Bay Area. Excellent weather as usual. Looking forward to the rest of the week, rest of the weekend, getting going with this understanding group investing. So a little bit about myself. My name's Steve Peterson. I'm the current president of the California Association of Real Estate Brokers. I started my company, Infinity Investments, back in 2009, amidst kind of the economic collapse that we're having in the country. I thought it was a great time to kind of get going. I saw a lot of investors being able to buy properties pretty much pennies on the dollar. When I started selling real estate and investing in real estate 2003 and 2004, the prices were escalating rapidly. And we got to about 2006, 2007, the prices were outrageous. And so when things dropped dramatically in 2008, you could have bought a house in Oakland for less than $100,000. You could have bought a fourplex for under $200,000, where only a couple years ago that fourplex would have cost $600,000-700,000. So when I saw that price drop, I thought there was, I thought there was a huge opportunity on the table, and I thought that, this is kind of the time for investors and people who want to invest to buy at prices that were reasonable in the Bay Area. Because when I got going in the business and watched this market get out of control, there really wasn't a lot of great deals. There really wasn't any cash flow available, especially in the Bay Area. Everybody was buying based on appreciation. And when that just, when that dried up, when there wasn't, when appreciation stopped and the market went down, there was no cash flow. And it was an interesting time. Anybody who lived through the business in that time knows it was a very difficult time. However, now fast forward to 2018, had you bought some property in 2009, had you bought some property in 2010, 11, 12, 13, 14, you have greatly benefited from the rise in the market. And hopefully you bought right, so you had some solid cash flow coming in. So I think this is a real relevant topic now, because we're kind of in what I see is the beginning of a market shift. 2018 similarly looks like 2006, 2007, although there's some significant differences. The significant differences that I see, particularly, are the fact that this last market run up, there was a lot of cash investors in the market. There was a lot of people, in an investment property putting down 30 to 40%. So in the old market cycle, when things ran up, it was really funny money. Lenders were giving you 100% loans for investment, like a fourplex. For apartment buildings, they were giving you 90% loan to value, which is almost unheard of. They were lending based on what's called pro forma. That's the projected income and expense, not the actual. Something I talk about in a lot of my webinars or a lot of my seminars. I go over the basic fundamentals of income and expense because those are the key to real estate investing. And what happened is even the lenders in the last market cycle got away from that. And so this last run up that we've gone through, really from like 2011 to now, has been, for the most part, a legitimate run up. It's been a lot of cash. It's been a lot of capital. Now people think that, quantitative easing or the government bailout helped to put a lot of capital in the market, but it's nothing like it was before in a sense of just unique financing options that ran up the market. This has been more of a organic growth cycle. So, I think that we'll benefit when this market shifts, which I believe it's doing now. Those that are buying on fundamentals are going to reap the rewards. Right now, it's in the last few years, it has been very difficult time to buy. You're getting outbid, prices are shooting up. So as we go through this market shift, what's important is that you're able to, if you want to buy, a couple of things happen when the market shifts. Capital gets tight, right? Money gets tight. So when money gets tight from lenders, usually investors act the same way, or just the economy tightens up. Maybe a couple of companies, couple of tech companies start laying people off here in the Bay Area. That would be, that would I wouldn't say be catastrophic, but it would be a problem. And then, just money in general is tight. So the biggest thing I saw in last market cycle, where people who wanted to invest got caught up, or not got caught up, but where they got tripped up, is that they wanted to invest, but they didn't have the money to invest, or didn't have access to capital, or lenders weren't lending. And so a lot of people got discouraged. And I remember pitching so many deals. I just remember, like in West Oakland, for instance, was a real hot neighborhood. You got a fourplex in West Oakland now, all things considered, it's probably worth $1 million plus, right? In 2009, 2010, 2011, I remember working on 3 or 4 different fourplex transactions. And I would just be calling 1,000 people trying to convince them to buy this property in West Oakland for under $200,000. Most people would say, no, it's too much. West Oakland's, that neighborhood's depressed. It's never coming back. And then people who were interested, by and large, didn't have the cash. The people who did have the cash, the people who did have the resources or access to capital, they cleaned up, man. I mean, they cleaned up. And it was, man, I don't know the stats or anything like that, but I know this. It was one of the biggest wealth creators probably in history. So if you bought from 2010 to 2014, even if you didn't know what you were doing, you just held on for a couple of years, you made some money. So I wanted to do this seminar, the webinar on group investing, because I do see a market shift, and I want to kind of get folks prepared to start thinking about that now, while the times are still good, so that when it does shift, you can be prepared. You can hopefully, have some resources to put some capital together if you don't have capital, to then go after some life changing deals. You buy property at a discount and it appreciates in a few years. You make $500,000. That's a life altering situation. So I want to try to help some folks be able to understand that and get involved in that. So with that being said, I'm going to kind of get into the presentation. So what exactly is group investing? Now, here's something a lot of times you hear that word group investing, and a lot of people just, I talk to people about it. There's 1,000 different ideas of, what group investing actually is. So it's basically when two or more investors get together to acquire property, when they effectively are a group that owns the property. It's just two or more people. That's a group. The structure, however, can take many different forms. And when I say structure, I'm talking about the legal entity, how the group is structured, how it's set up. Um, the first structure is joint tenancy. That's a very common structure, but it's not as legally, it's not the best legal structure. There's a lot of liability for all the partners in that way, and it doesn't give you the protection as some of the other structures. Tenants in common is another structure that you can buy property with groups. There's a couple different ways of doing tenant in commons. There's where, let's say you buy a fourplex and each unit is a tenant in common and people own their own unit, kind of like a condo. That's more of a condo style tenant in common. The investment style of tenants in common is, let's say 4 people get together and they go buy a large apartment building. And then each one of them owns a percentage of the deed, let's say 25, 25, 25. And they actually have that deed. There's 4 different deeded interests into the property. Then there's like a general or limited partnerships, which are kind of, there's a lot of you hear people say LPs, limited partnerships. General partnerships are not the best way to own real estate together because everybody is liable for everything. In a limited partnership, the managing member, the person who puts together the group, they're going to be liable for the debt, the mortgage, any issues that come up with the property. And then the limited partners, those are the investors, their only risk is the cash they put into the deal. That's what are called limited partners. And people say the only risk. Yeah, there's a lot more risk in real estate investing than just losing your money. You could actually lose your money and the property going to foreclosure, bank sue you, tenant sue you, all of that. I don't want to scare you. I just want to keep it 1,000. The reality is there's risk. And when you're a limited partnership, if you invest with a limited partnership, you're only risking your capital. So you don't have the mortgage liability. You don't have, tenant liability or so forth. So that's with general and limited partnerships. Those are kind of some of the details. Now, limited, what's most probably popular right now is LLCs, limited liability companies. Now, most people are familiar with the LLCs. Most businesses today are formed in the form of an LLC. It's very similar to a partnership, very, very similar to a limited partnership, but it's different in a couple different ways. And LLCs are flow-through entities. So however much of a percentage you own, you're going to get that percentage of income and export profit. You're going to get that percentage of cash flow. You're going to get that percentage of depreciation. And if you don't know what depreciation is, that's a tax term. It's just a benefit you get when you buy real estate because physically buildings depreciate. So every year on your taxes, you're able to get a write-off for depreciation, even if the property actually in value is appreciating. Okay. But that's part of one of the benefits of a limited liability company. One of the negatives of an LLC is, let's say you're doing a 1031 exchange. You sell a property and you're doing a 1031 tax deferred exchange into another property. When you do that, you have to have what's called a deeded interest into the property. That would be handled under like a tenant in common structure. An LLC, you own a percentage of that company, and then that company owns the deed. Now you can combine an LLC with the tenant in common structure. A little bit more complicated, but people do it all the time. But just something to be aware of. Nowadays, I don't have it on my list, but there's what's called a DST, a Delaware Statutory Trust. I'm not an expert on DSTs. It's kind of it's not a newer concept. It's been around, but it's kind of the popular structure right now. All I can tell you is if you're doing a 1031 exchange, or if you are putting together a group and you're soliciting investors who are doing 1031 exchanges, then a DST, a Delaware Statutory Trust, is an instrument that will allow them to invest with you and still be in compliance with their exchange so that they don't pay taxes. A couple other structures, real estate investment trusts. These are called Reits. These are really for the larger deals, the more institutional deals, 200, 300 unit. and they're set up for a larger number of investors. If you're just starting out, that's probably not the way to go. But if you've got some experience doing limited liability companies, tenants and commons, and you want to move up to the next level, then you may want to consider a real estate investment trust. Those are just some of the structures. So when you hear people talk about group investing, these are some of the structures, the most popular structures, and there's more, but these are the most popular structures of what a group is that buys real estate. All right. What we don't want to see is 4 different individuals taking title individually. That could be a nightmare on a lot of different levels. All right. When you do this, you got to do it in a professional way. This is not the time to cut corners and save on a couple of dollars. What you really want to do is do it right. Get an attorney involved who can advise you through this. All right. So why invest with the group? I think there's a couple obvious reasons. One thing is, hey, you see a great property, say it's $1 million, that requires maybe 300,000 down, and you got 50,000, or you have nothing. But maybe you got good credit, you can qualify for a loan. You have the desire to run a property. You got some property management experience, but you can't buy the property by yourself. So it's an excellent way to go and acquire a building that you couldn't do by yourself, is to put together a group to purchase it. And think of it like this: most large commercial properties of any kind, hotels, office buildings, apartment buildings, whatever, they're purchased with the group. Even large, investors and syndicators who got hundreds of millions and billions, they still put together groups to invest because it just makes economic sense. All right. Now, also, there's a way, when you're doing this, you can limit. Let's say you have $100 million to invest. That's great. That's fantastic. But it's still limited, right? If you want to do $1 billion property and you have $100 million, you probably don't have enough to get the deal done. Now, so you would have to go out and raise capital. Then let's say you have $100 million and there's a deal you're looking at and it requires $100 million to invest. Do you really want to put all of your $100 million or whatever that amount is into one deal? Probably not. So an alternative to that would be to put together a group. Now, another thing to think about: some people don't like managing property, or some people have construction skills, or some people know how to find properties. All right. When you form a group, you can put together the strengths of other members in the group to make a stronger team. And that, I think, is really the benefit of this, is putting together a strong team that you can then go out and accomplish more than you can individually. Right. And so I think that's the key to investing in a group, is having a strong team of people. Now, when you do this, hopefully, now there's also going to be a couple categories of people who are maybe watching this. People who are going to put together the group, we call those sponsors, and then investors, passive investors, who are going to put up the cash as an investor, but you're not going to do the work of running the project, right? Whatever that may be. All right. Some buildings, if it's a 20-unit luxury building, that's easy to manage. If it's 200 units in the hood, that's probably not going to be so easy to manage. Or let's just say you're in a rent control market where there's a lot of laws to deal with versus a non-rent control market where it's pretty straight up and down. So, when you're in that type of situation, rent control, there's a lot of details you need to be on top of. So some people not want to be on top of, they're not going to want to be on top of that. Some people maybe have that expertise. And so if we come together, we can do more than we can individually. That's the whole concept of this, is to do more than you can individually with the group. All right. Now, I talked about some of the pros of group investing. Now I'm going to talk about some of the cons. All right. With anything, there's always going to be some pros and cons. Okay. So I'm not going to sit here and tell you everything's going to be Pollyanna. Everything's going to be peaches and cream. The reality of investing in a group, the reality of life is there's always going to be ups and downs. There's always going to be pros. There's always going to be cons. All right, let's go over a couple of the cons. First of all, real estate in and of itself is illiquid in nature. What that means, it's not like the stock market, or it's not like the bank. You go put your money in the bank or put money in stocks. You typically can liquidate or get your cash back in a matter of days. Even if you buy property on your own, it takes time to get your cash back. You know, and when you put the property, even in a hot market, you put a property on the market for sale, it gets in contract, say a week. If there's still going to be an escrow period, even if it's all cash. I mean, at the quickest, it's going to be 2 to 4 weeks. Most likely, especially in commercial real estate, it's going to be anywhere from 60 to 90 to 120 to half a year. Okay. So, and that's at the point of when you say, hey, I want my money back. Now, when you invest as a group, you don't get to just say, hey, I need my money back right now. Give it back to me. It don't work like that. When you come into that group, there's going to be an operating agreement of some sort. Okay. Depending on what the legal structure you choose, that operating agreement is going to address when money comes in, when money comes out, how money gets dispersed. You know, how do we go ahead and liquidate? And it's not just you saying, hey, I need my money back and I'm gonna get my money back. It don't work like that. Okay, so it's a group decision. Whoever's the sponsor of the group is gonna, you know, kind of be responsible for running the property, selling the property, reporting back to the investors. So there are some, you know, there are some negatives in that sense of, okay, whatever move you make, or when you come together as a team, you want to know going in that this is not like a short-term thing, and it's something that you really need to be in for the long term. It's, you know, that's just kind of what you got to be aware of. Also, transferring individual ownership can be complicated. Okay, so let's say you own 20% of a group, a LLC that owns a property, and you want to get out, but the rest of the partners, they love it. They don't want to sell. You can transfer your 20%, but that 20% is not, that's not easily done, is what I'm saying. It can be done, just not easily done. Now, let's say you're the sponsor putting this together. Another con could be you could lose control of the operations, right? The other investors can vote you out. They can, that it's possible for you to lose your control. Dealing with partners also can be pretty difficult. Life's too short to work with people you don't like and trust. So you want to try to, whoever it is, if you're doing group investing, you want to try to make sure you're working with people you like and trust. So those are just some of the negatives. There's probably others. I want to be real with you. I want to talk about some of the positives, then I want to talk about some of the negatives. The reality is that it's a great thing to do. There's some risks and there's some things to consider when you're doing it. But it's how most big investments gets done. It's how a small group of people with not a lot of resources can start taking down big properties and start building wealth in their communities and their families. I've seen so many people who come from, I wouldn't say poverty, but maybe lower income levels, move up rapidly by putting together small groups and buying property, especially by timing it right. That's why we're doing this webinar now, as I see the market shifting, so you can start timing, getting your stuff together. If you now spend the next year figuring out, studying group investing, and in a year from now are ready to go, I think you'd be poised perfectly to then go in and acquire some properties at the, and probably at some good prices. So now what I'm gonna do is kind of get into some of the nitty gritty. Group investing is also referred to as syndications. The word group investing and syndications are often interchanged for each other. A syndicate may be defined as a group of people who form an association to undertake a business transaction. All right, and that's it's like a Webster's dictionary. My way of looking at it is just a syndicate, a group of people or organizations that put their capital together, put their cash together, put their resources together to go to go acquire property. All right. There's a book called It's a Whole New Business by the author Gene Trowbridge, CCIM. And he goes into real details about syndications as it relates to real estate. So if you are serious about putting together groups or serious about investing in the groups, I do suggest you look up It's a Whole New Business, author Gene Trowbridge, cop it. I think you can snatch it off Amazon or go to Google Gene Trowbridge. You can go to his website. But it's something you certainly want to become more educated on. And Gene is really kind of one of the foremost experts in this area, in this field. His company also does the legal work for several thousand transactions, particularly in syndication. So, get educated as you possibly can. I'll give you some other resources as we go through it. But just on my slide, I kind of here's a rough example of a syndicate. You want to buy a 20-unit apartment building. It costs $2 million, but you personally don't have the resources. Therefore, you form a syndicate of 10 investors who contribute 200 grand, right? 200 grand, that each brings you to 2 million, right? And in that instance, you guys will be paying cash for the building. Now, any agents and brokers out there or investors who've been outbid in the last 5 years on deals? A lot of cash investors out there, right? A lot of cash investors, people selling property. They love cash investors. Do you know probably the majority of those cash investors are groups who've put together cash either in a fund structure or, they just come together and said, hey, let's put our cash together to go buy property. Oftentimes that's what it is. And there's been a lot of foreign groups coming in and snapping up properties this way. All right. So you may not have cash. A lot of times people, I can't do this. I can't do this. But that's when you're just thinking about you. When you take it from the context of group, then your world opens up. So that's the main thing I want to get you to understand is that this is possible. You can pay cash for a property in LA or a property in the Bay Area. You put together a couple of investors to get it done. I don't want to make it seem like it's easy because it's not, but it's possible. All right. Now I'm going to go into some of the details about raising money for the syndicates. So here's something to think about. When you are going and putting together a group, I just gave this example of, okay, there's a $2 million apartment building, and you go out there and you raise $2 million to acquire, right? You can also go and get a loan as well, FYI. But if you're able to do that, you come in cash, you're a little bit more aggressive. Sellers like all cash deals, right? So that means you got to raise money. You got to put the money together, all right? That's probably, now this is where it gets tricky. This is where it gets difficult. This is where you got to develop some skills. You got to develop a network as well, okay? I'm going to kind of go through, I'm going to read this slide and go through some of the details. Now, the rules of raising money have changed with the Jobs Act of 2012. This has created avenues to advertise investment opportunities for small businesses and startups. However, the best way to raise money is still in developing relationships. All right. However, there are methods now for you to be able to go out and raise money online. You still have to follow some specific rules, and you do this through crowdfunding. But there's a bunch of rules you've got to follow, and I'll talk about that in a future slide on crowdfunding. But it's possible. Okay. Now, like I said, the best way to raise money is through developing relationships. And here's just a couple bullet points of how you can go out and develop relationships with people who may have capital who might want to invest with you. So first thing you do is you network. You network at real estate seminars. You network at real estate trade shows, events, mixers. All right. With this webinar we're doing is usually a meetup a seminar where we get together and meet. I'm trying to, step up my technology game, and I still got a long way to go. That's why we're doing a webinar, but we always do seminars where we meet. Yesterday, I was at the Realtist Summit in Berkeley, hosted on by our local board, Associated Real Property Brokers. So in the building was about 70 to 100 people talking about housing. So I got up and said some stuff as the president of the state, and I got 2 contacts from the meeting. And those 2 contacts were some heavy hitter people that own apartment buildings that, are looking to buy and develop apartment buildings. So for me, that was I was there to represent the organization, to represent democracy in housing, but I got business out of it because I got 2 contacts that I will add to my network that I can talk to, let's say if I'm putting together a group about a deal. So you got, what I would recommend is at least 3, 4 would be better, but 3 to 4 of these events per month. All right. And what I try to do is 1 a week. I end up doing at least 1 a week because I'm involved in so many different organizations, the Realtist organization and the CCIM organization. And then I'm always at a networking mixer. So it's kind of how I came up in business. But a lot of times people just miss out on that. Also, your pre-existing business acquaintance. If you're a broker, an agent, you've got a book of business, or you should have a book of business unless you're starting out. So these are some of the great times. If you find a great real estate deal and you've sold somebody a piece of real estate in the past, that might be a great person to talk to about going in with you on that. All right. Obviously, you got to be, you got to be careful with the relationship. But, if you're doing something that you believe in, the numbers make sense, why wouldn't you talk to a past client? Why wouldn't you talk to somebody that's a business acquaintance? Another thing is referrals from accountants, attorneys, other financial planners and wealth managers. I did a deal in 2005. We raised about $1 million. I raised $1 million for an apartment complex that a sponsor was buying. So I was part of the team. It wasn't my apartment complex, but my goal or my role in that team was to go raise money. So I raised $1 million through connecting at a networking event with a wealth manager. And this guy managed a lot of money for wealthy people in the Silicon Valley that were looking for real estate deals. Obviously, he put them in stocks and bonds and different instruments, but he had the ability to also put them in a real estate deal. So when we connected, showed them the deal, they liked it, worked out. So wealth managers, financial planners, CPAs, attorneys, you want to stay in constant communication with these group of folks and letting them know that you are always putting together deals and you're always looking for deals. If you find a good one, can you call them and talk to them about it? Most of them will say, yes. Some of them will say, scram, get away, don't talk to me. But that's just part of life. You got to go through the numbers. You got to talk to people. Another source of contacts is property owners. People who own property now. So, and if you're, again, an agent or a broker, that's why this is good for agents and brokers. I wanted to do this for the California Association of Real Estate Brokers. We have a great group of brokers and agents. We are called Realtists. And not enough of us invest in real estate, right? Because we're so busy out there selling real estate, which that's a job. But to invest in real estate is where we're building wealth, right? This is such a great avenue for, if you're a realtist or anybody who's an agent or broker, for you to build your own wealth portfolio while you're still running your business. All right. But it's also obviously whatever your profession is, apply the same principles. Last thing is engaging a crowdfunding site to market your offering. I'm not a crowdfunding expert. I'll give you a couple of crowdfunding sites, but the bottom line is, hey, crowdfunding is opening up the door for people to raise capital, the small businessman or woman to raise capital on a major level. Okay, not like Schwab or those guys, but it gives you access to people who you don't know necessarily to be able to invest with you. Now, in that vein, legal disclaimer, you still got to put together some legal disclosures. There's something called a private placement memorandum that you're going to want to engage an attorney to put together for you as you raising this capital, and or a subscription agreement if you have a smaller deal. But That's going to cost anywhere from 2,500. Some people charge 15,000 for it. But that's the money you want to spend on the front end, so you're not spending it in legal fees on the back end. All right, very important. As I move through the presentation, now I'm going to kind of talk to or speak to the fact of some particular individuals who would be good prospects for syndication. Now, we've kind of talked about some strategies of raising the money. Now I'm going to talk to the specific individual targets who you want to go after. Maybe go after is not the best word, but you need to have a target. Of you doing anything, you want to have a target. You don't want to just be shooting at the wind. You've got to have a bullseye. So here are some of the people who it kind of benefits them in a way, more so than others, to invest in a group. First group of people are folks that have what's called a self-directed IRA. Self-directed IRA, an individual retirement account. If I'm saying IRA wrong, I'm sorry. But the self-directed IRA investors, this is where they make their decisions on where their money goes, not Charles Schwab or whoever else. They set up a custodian. There's a couple different ones out there, but one of the big ones is Pensco or Intrust. These are what's called IRA custodians. Let's say they move their money from Schwab to Pensco. Now they can use the money from their IRA, their self-directed IRA, to purchase real estate or invest in real estate. So here's the key as to why these are good potential investor prospects, because it's an IRA. So these investors, they can't touch the money or they're going to be taxed on it or penalized. So what they got to do is keep their money invested into whatever asset that they're in. So these are good candidates for group investing, meaning that they're going to be a little bit more long-term investors. So, a group might work out for them. It's still the deal has to make sense. You still have to present yourself and be a trustworthy and responsible person. But self-directed IRA investors are a great group of folks who would be interested. Also, 1031 exchange investors, people who are selling property and they have to buy another property or they're going to pay taxes. Right. And what's happened, I've had this a few times recently where we sell a property for somebody and it's very difficult to find another property, outright. So sometimes these folks are great candidates for a group of investors. Also, just, busy professionals, executives, or people who making, a lot of money, but because they're so busy in their profession, they don't have time to go buy a building and run it. But maybe you do. And they can maybe put some capital with you. They like you. They trust you. They think you know what you're doing. And so that's, again, a good group of folks to kind of go after. And then I just said also ambitious investors seeking to invest in projects larger than what they can do on their own. So a lot of times those are the people putting the groups together. But let's say you're putting a group together and you come across one of these guys and they have some capital. They also probably have some friends they could talk to. So these are some specific individuals to target. We talked about some strategies. Then here are some specific individuals to target. And now I'm going to kind of go into just a little bit of crowdfunding. And so crowdfunding, we talked about as a great way of raising capital. And I'm going to wrap the presentation up in about 5-10 minutes. But this crowdfunding is a new popular thing. There's a lot of kinks that need to be worked out. And I say it's new, but the actual idea of crowdfunding has been around for years, for years on top of years. What we've done is it's become popular with the Jobs Act because we've allowed the internet is a method of raising money through crowdfunding. But crowdfunding has been around for years. And what was popular in the past is like mail order crowdfunding. And I don't know how they did that, but they would mail order investors to solicit them to invest and then put together the group. But now you can do that online. And so I'll just kind of give you some definitions. The practice of funding a project, crowdfunding is the practice of funding a project or venture by raising monetary contributions from a large number of people. Today, it's often performed via the internet mediated registries. These are called the platforms. But the concept can also be executed through mail order subscriptions, benefit events, and other methods. That's why I say crowdfunding has been around for years. We just now have the internet platform to do it. That's why it's so popular. And the crowdfunding model is based on three types of entities. The project initiator, that's the person who proposed the idea or project to be funded. The individuals or groups that supports the ideas. These are the investors. Then the moderating organization. This is the platform, okay, that brings the people together. So the project initiator goes to the platform vets the project, then the platform blasts the project out to the world. Okay, so those are the three types of entities via crowdfunding. Now, the basics of crowdfunding for equity. Okay, let me just say this. There's also crowdfunding available for debt, for lending. Okay, well, we're gonna, for the most part of this presentation, we're talking about equity, so you can go out and buy properties. But they also have lending available through crowdfunding. But we're talking about equity. So really, crowdfunding became popular via the Jobs Act. All right, of 2012. It was put in place by the Obama administration to spur economic growth. As we talked about in the beginning of the presentation, economy was down after the market crashed. And so the Jobs Act, the Obama administration put together the Jobs Act to spur the economy. And in doing so, this essentially encourages small businesses and startup funding by easing various federal regulations, which allows businesses to accept small amounts from private individuals. And there's basically two tiers of crowdfunding. There's the Title II version of crowdfunding. That's where you have to be an accredited investor. All right. What an accredited investor is essentially is someone who's got $1 million net worth, not including your home equity. So you have $1 million net worth in addition to your personal residence equity. And or you as yourself or as a couple are making over $200,000 a year, and I believe you had to have made that in the last 2 or 3 years. So the government looks at accredited investors as people who can afford to lose money. So to speak, I think nobody can afford to lose money, but that's the way it's set up. Title III is what allows non-accredited investors to invest. Anybody and their mama, somebody's got $1,000 net worth and wants to invest $1,000, they can do so through Title III. However, there's still some legalities and disclosures that have to be done. That's why I say you need to have a lawyer prepare a private placement memorandum or a subscription agreement for your investment. But just understand, under Title III, people who are non-accredited can invest. Now, the key to all of this is that you can advertise, okay? Because you can always talk to people about investing, but unless you're, Charles Schwab or something like that, you in the past were not able to advertise your investment. Under Title III, you get with a platform, now you can go and advertise, mass market your investment. There's one thing about crowdfunding that you take away is it allows you to mass market your investment. Where in the past you weren't before the Jobs Act, you weren't able to do that unless you were set up as a securities firm. All right. And I'm not a securities expert, so I'm not gonna go into all of that. Just know that that's the key of what crowdfunding allows you to do, is be able to then go out and raise capital online when you couldn't do that before. So it should, in this design, open up the capital floodgates to the small business person, right? The individual like you and me who want to go out and put together a group to go buy real estate. That's what this is all about. All right. And we'll wrap up. I want to give you some crowdfunding websites that you can have. Now, these are some bigger ones, and they might, like if you're doing small groups, they might not be the site for you, but it gives you a basis to start doing some research into these platforms. Now, these websites are the platforms that you can go to. So if you have a project, you bring your project to the platform. It costs money. It's not free, but you can bring your project to the platform. And most of them charge a fee up front, anywhere from like $5,000 to $10,000. I think some of them are less than that. And then I think they get like a some, I don't want to call it a commission, but some sort of fee based on how much cash they raise. So it ain't free. Nothing is free, but it can be an effective method of going out there and raising capital. So just a couple of websites that you can look into. Crowd Street, big platform. Realty Shares. Realty Shares, I don't know if they're the biggest one. I know they've raised over $900 million in the last few years for real estate particularly. I recently met one of the angel investors in Realty Shares. It's been and he was saying it's been a real successful platform. So you might want to look into Realty Shares. Also, Patches of Land. I believe they're based out of the Bay Area. Also, Groundbreaker, Crowd Baron, iShares, Prodigy Network, Fund Rise, and Realty Mogul, just to name a few. And what I would suggest, if you're interested in this, is start to research what platform would be right for you. We don't, depending on your project, depending on what you're doing, it's going to vary. And like I said, I want to just keep this, consistent, is that the best way to raise money, we still have a lot of technology, a lot of different avenues to go about, raising capital. The best way to do it is through your network and your relationships. So the key is to build your network every single day. Build on your relationships every single day. And if you're in real estate already, I think, or any business, you're financial planning, you're an accountant, you work in HR. I think relationships are the key to most of anything in business and in life. And so if there's one thing I could say in terms of putting together a group, is that you've got to have good relationships. You got to build good relationships. You got to add people to your network, and then you got to go after it. Now, and when you do so, the word of caution is make sure you do it with a group of people you love and you trust. People, because what happens is everything is not peaches and cream, right? So when there are some challenges, you want to make sure you in the fight with people you can work with, that people you trust, and it don't always go right, but you want to know that if it go wrong, that you in there with some people who are going to stand in the fire with you and that are going to work with you. And so that's what I would, word of caution or advice, if you will, is I say, make sure that the team of folks that you're working with, don't just go after somebody who says they got the money. Let's just do this deal. Now, sometimes you might have to do that. Let's say you're raising money and you're in a crunch and it's the 11th hour, but that's just recipe for the disaster. If you're diligent about it and you kind of get your group together before you go after the property, then that way you can be engaged in the process, and you can be engaged into the property, and hopefully that the team will stay together and the team will be profitable together. So that's the basics of the presentation. That's all of the slides on the presentation. I'm sorry about the technical difficulties, you guys. We will make sure for all of you attendees out there, we will actually send the entire presentation to you, and you can see that in the details of it. I hope that this has been helpful. I hope that you can take some of these ideas. Maybe there's one idea you like, maybe there's something you don't like, but the key is to inspire you into action. And like I said, today was October. I'm sorry, getting ahead of myself. September 26th, 2018. I think the market's shifting. I don't think it's shifting. It is shifting. Which way it's going to go, I don't know. But I'm just looking at, experience, right? The last market cycle crashed in 2008. That was 10 years ago. So usually real estate cycles run in about 8 to 10 year time frames. So we're kind of at 10 years from the last crash. And I don't think that it's going to crash like it did before, but I think it's going to settle. I think it's going to shift. And if you're patient, if you get your ducks in a row now, then you maybe can benefit from that. because there were so many people that I saw in 2009 that, I mean, I was on the firing lines calling people, I got this great deal, invest with me on this deal, buy this property, and folks wasn't ready. Or they mentally weren't ready because they didn't spend the time preparing in the good time. So when it got bad, it just was in survival mode. It's tough. It's tough to invest and move forward in survival mode. You can do it, but it's just tough. That's why I'm telling you now, invest the time while things are still looking good to get educated and to get confident on investing and investing in a group, so that if you want to do that, so that when we are in a shift, and that when there's buying opportunities, that you can strike and you can get on it. Because there, I mean, one or two deals, especially in California, there's people who are listening to this maybe not in California, but especially in California, we have wild rides in the market, up, down, right? You time it right, you can get rich, and more than getting rich is that you can set up a legacy for your family. All right. You know, everything's expensive in the Bay. Everything's expensive in LA. Everything's expensive in Sacramento, Stockton, Bakersfield, Fresno. It's going to be expensive there too. So you've got to start making some moves now that you can, so you can sustain it, so that your kids can sustain. Think about it now when it's good. So when it's a rainy day, you've got a plan for it. So with that being said, I'm going to wrap it up. We have a big conference coming up from October 24th to the 26th in Oakland at the Marriott. You don't want to miss it. Jay Morrison is going to headline. And if you know or have heard of Jay Morrison, he's going to be the keynote speaker. He is a big time advocate for group investing and investing. He has this whole buy back the block campaign that he's been doing in inner cities throughout the United States. He's going to be our keynote. There's going to be a heavy investment theme to the conference. There's going to be a lot of breakout sessions, a lot of structured networking, a lot of information in there about, how to, increase your sales pipeline, increase your listings if you're a broker and agent. And we're going to do this group investing session in a lot more detail. And then we're also going to address some legislative things, at our conference. So you want to make sure that you're there. Oakland, California, October 24th to the 26th at the Marriott. And our gala is going to be at Jeffrey Pete's on Friday night on October 26th. So make sure you're there. If you want more information, you can hit up, go to our website. We'll Google CAREB, California Association of Real Estate Brokers, because we have it on our website. We have it on our Eventbrite. Also our YouTube station, we'll be broadcasting this. So just engage with us. Come to the conference. And I think that if you're going to be investing in real estate, whether individually or with the group, you have to stay constantly networking, and you have to stay constantly educating yourself on what's going on in the marketplace and what techniques and strategies that you can implement. I hope it's been good. We're going to log off now. Everybody have an outstanding day. And remember, the California Association of Real Estate Brokers State Conference, October 24th to the 26th, Oakland, California. Be there. All right. Have a great one.